Gold has just hit record highs, but there's a catch. The big question on everyone's mind is a crash on the horizon for 2026. Now, you might think a surge like this always ends in disaster, but here's the thing. This time, it's not as straightforward as it looks. In fact, there's a key factor that most people are completely missing. Stick with me, because I'm about to show you why this historic rise in gold prices could lead to something much bigger, or something you won't see coming. Trust me, you'll want to hear this before it's too late. So here's where we stand. Gold surged by a staggering 64% in 2025. That's more than triple the gains of the S&P 500, which only went up 16%. On the surface, it looks like a dream run, right? But here's the thing. When you zoom out and look at the bigger picture, say a 30-year chart of gold, things start to look, well, a little unsettling. Suddenly, this steady rise doesn't seem so secure. Gold's climb is starting to look like a mountain that can't keep going up forever. But here's the question. Can it? Or are we about to see a massive turn? Stick around, because there's a reason no one's talking about this crucial detail, and it could change everything. Now let's break down the real reason behind gold's rise and why it could all come crashing down. You see, gold doesn't just climb because it's getting more expensive. No, it rises because people lose confidence in fiat currencies, especially the US dollar. That's the key point most analysts miss. And looking back at history, we can pinpoint exactly when this happened. The famous gold crash of 1980. Gold hit $850 an ounce in January of that year, only to collapse by 65%. But here's the part most people don't understand. Gold didn't crash because it was overpriced. It crashed because confidence in the dollar was restored. And that's what you need to understand about today's gold market. So here's a critical question. Do you think we're seeing that same loss of confidence today, or is there something else at play? So what happened in 1980 that caused the gold crash? Inflation was out of control, oil prices were spiking, and the public had completely lost trust in the dollar. People flocked to gold as a safe haven, and the price soared. But then, under Federal Reserve Chairman Paul Volcker, things changed fast. Instead of gradual interest rate hikes, Volcker slammed rates to nearly 20%. Now think about that for a second. Interest rates at 20%. Can you imagine the impact of a 20% mortgage rate today? But here's where it gets interesting. As painful as it was, those high rates broke inflation's back. Suddenly, confidence in the US dollar was restored, and gold. It no longer had the same role as a safeguard. Gold crashed, not because it was overvalued, but because the real value was restored in the dollar. The dollar became the safe haven once again. So let's think about this. If the U.S. could raise rates that high back then, can they do it now with over $38 trillion in debt? Now let's talk about the real kicker. When we compare today's situation to 1980, we see a massive difference. The Fed's interest rates are nowhere near those levels. We're sitting at 3.75% right now, far from the 20% rate of Volcker's era. But that's not the whole story. Even though rates are higher than they were during the zero interest days, inflation is still running hot, well above the current rate of interest. This means we're in a period of negative real interest rates. Put simply, holding cash right now is actually losing value. Let that sink in. People today are still using gold as a hedge against that erosion of purchasing power. But here's the big twist. What happens when inflation is tamed and interest rates finally surpass it? If we look back at history, this is the point where gold loses its shine. But here's the part nobody is saying out loud. With current debt levels and global instability, it's hard to imagine those high rates coming anytime soon. So could gold hold its ground longer than expected? Let's dive into what that could mean for you. Now, things start to get complicated. We're seeing a perfect storm of factors that could shift the entire game. First, there's the U.S. government's debt. Now over $38 trillion. Back in 1980, debt to GDP was about 30%. Today, it's over 120%. This changes everything. If the Fed tried to hike interest rates to 10%, 15%, or 20% like Volcker did, the cost of servicing that massive debt would be astronomical. So, what does that mean for gold? It means there's no way the Fed can get inflation under control the same way they did in the past. That puts us in a dangerous spot. But it doesn't stop there. Central banks are buying gold at record levels, diversifying away from the US dollar. This isn't the same environment we saw in previous gold peaks, where once the dollar stabilized, gold lost its edge. Today, there's a persistent demand for gold that changes the entire dynamic. So here's the question. If gold's role in the global economy is shifting, what's really keeping the price from skyrocketing even further? Now let's step back and look at the human side of all this. Gold's not just a number on a chart, it affects real people. If you're someone who's been watching your savings lose value due to inflation, or if you're constantly worried about where to park your money, you get why gold is such a big deal. It's a refuge, a way to preserve wealth in a time when the dollar just doesn't seem as trustworthy. And that's where the real pain is felt. Ordinary people like you are bearing the brunt of this crisis. You're stuck between inflation eating away at your purchasing power and the uncertainty of the stock market. Gold offers a way out, a hedge against both. But here's the thing, this pressure, it's not going away anytime soon. If you've felt the weight of rising prices, or if you've started moving some of your money into gold just to keep up, you're not alone. Let me know in the comments if this feels familiar to you, because what happens next might just redefine how we think about wealth. But let's go beyond the pain of rising costs and dive into what's really going on behind the scenes. Gold, like all assets, doesn't exist in a vacuum. There's a system at play, a system where central banks, policymakers, and financial elites hold the keys. The key mechanism here is confidence. You see, gold thrives when there's a loss of trust in fiat currencies. When people lose faith in the dollar, they flock to gold as a safe haven. But the moment confidence in the dollar is restored through real interest rates, fiscal discipline, and policy action, gold's role shifts. And that's the problem. In today's world, we're seeing the exact opposite of what happened in the past. Central banks are still buying gold, but the dollar's global dominance is being challenged. Countries are moving away from using the dollar as the world's reserve currency. This creates an unstable environment where gold's status is uncertain. Here's the unsettling truth. When you look at the global financial system, it's not just about gold or the dollar, it's about a much larger game. One where the rules are constantly changing and the stakes are incredibly high. So where does this all lead? What's next for gold and the broader financial system? Well, there are two possible paths, but neither one is clear-cut. On one hand, we could see a period of volatility and consolidation. Gold could move sideways for a while, stuck within a range as investors wait to see how the global economy plays out. It could be years before we see another massive surge. But then there's the second scenario, sharp corrections within an ongoing bull market. Gold could take a hit. Maybe 10%, 15%, or even more, based on news, politics, or a sudden shift in the economy. It would feel like a crash, but in reality, it would just be a temporary setback. The bigger picture would still be intact. The real question is, how long can this bull market continue before we hit a tipping point? And when it does come, what will the next major shift look like? And here's the bottom line. Gold doesn't fall just because it hits a new high. It falls when confidence in the currency system returns, when real rates exceed inflation, and when central banks prove their policies can stabilize things. But right now, we're not seeing that. In fact, the conditions that led to past gold crashes simply don't exist today. What we're witnessing is a new phase, where gold is more than just a hedge. It's a cornerstone of financial strategy in an uncertain world. So whether gold continues its rise or faces a sharp correction, one thing is clear: the game has changed, and the rules aren't what they used to be. Stay tuned, because this story isn't over yet. And if you want to keep up with the latest insights and strategies, make sure to hit that subscribe button. Thanks for watching, and I'll see you in the next one.